In the world of medical technology, 2025 has been a really weird year. On one hand, you have a giant like Becton Dickinson posting incredible record-breaking revenue. On the other hand, you've got another titan, Baxter, reporting a jaw-dropping loss. Now, if you just look at the headlines, it seems pretty simple, right? A winner and a loser. But the real story is so much more interesting. All three of the big players, BD, Baxter, and ICU Medical, are in the middle of this massive reinvention, and figuring out why is the key to understanding where the entire healthcare sector is headed. So let's start with the good news. The powerhouse, Becton Dickinson, or BD as most of us call them. Get this, they pulled in a massive $21.8 billion in revenue for their 2025 fiscal year. That's up over 8%. So you look at that number and you think, okay, this company is the picture of health, the clear leader. But hold that thought, because that's only one piece of a much larger puzzle. And then you see this, Baxter International, another absolute giant in this space, reported a $308 million operating loss for the same time frame. A loss. So you've got the market leader pulling in record cash, and one of its biggest competitors is hundreds of millions of dollars in the red. These two are supposed to be heading in the same general direction. So what on earth is going on here? And that really brings us to the core question we're going to tackle in this explainer. Are we looking at a whole sector in crisis with all these hidden problems bubbling up to the surface? Or is all this chaos actually a sign of some really smart strategic moves, creating what might just be a huge buying opportunity for investors who know where to look? To figure that out, we have to peel back the layers and look past those crazy headline numbers. Here's how we're going to break it all down. First, we'll decode the financials, because you've got to understand why those numbers can be so misleading. Then, we're going to look at what I'm calling the Great MedTech Slimdown, this huge strategic shift that's happening. And finally, we'll wrap it all up with an investor's playbook, giving you the key takeaways for each company. All right, let's dive right in and decode these financials. That $308 million loss at Baxter, it looks pretty scary on paper. But it's hiding a much more complicated reality. The key to all of this is knowing that companies basically have two different ways of talking about their profits. And the gap between those two stories, well, that's where we find the truth.
Okay, so you've got GAAP earnings on one side. That stands for Generally Accepted Accounting Principles. Think of this as the official by-the-book number. It has to include everything, even massive one-time costs that have nothing to do with the actual day-to-day health of the business. Then you've got adjusted earnings. This is the story the company wants you to hear. It's where they take out all those special items to show you how their core business is really doing. To understand Baxter's loss, we've got to look at exactly what those special items are.
And the biggest special item has this jargony name, goodwill impairment. Let's break this down because it's super important. When a company buys another one, they usually pay more than its assets are technically worth. That extra amount is called goodwill. But if that new business doesn't pan out like they hoped, accountants force them to admit they overpaid. They have to write down the value of that goodwill. Now, it's a non-cash charge. No actual money is leaving the bank, but it absolutely hammers their official GAAP earnings. The analogy here is perfect. You paid a fortune for a beautiful classic car, but now you have to face the fact that the engine is a rusty piece of junk that needs a full rebuild. That's a goodwill impairment. And here it is. This is the smoking gun that solves the mystery of Baxter's loss. A whopping $485 million goodwill impairment, mostly from their big Hillrom acquisition. Another $290 million for writing down the value of the Welch Allyn brand. On top of that, you've got $133 million in real costs from Hurricane Helene disrupting production, and another $113 million set aside for problems with their infusion pumps. Just those items alone add up to over $1 billion. So you strip those out, and suddenly the picture of Baxter's actual operations looks completely different. The main takeaway here is this. The headline loss wasn't because the core business collapsed. It was driven by accounting rules and one-off disasters. Okay, so that brings us to part 2. If the financials aren't quite the disaster they seem, then why are all of these companies making such drastic moves? Well, it's because they're all facing the exact same set of intense pressures, and it's forcing them to completely rethink how they're structured. And man, it is a tough environment out there. You've got new U.S. tariffs hitting all the stuff they make in Mexico and Costa Rica. Over in China, the government is forcing prices down with a policy called volume-based purchasing, which just crushes their profit margins. Of course, you've still got sticky inflation driving up the cost of materials, labor, everything. As we just saw with Baxter, one bad hurricane can knock out a critical factory.
And if that wasn't enough, you've got stricter environmental rules that are forcing them to spend a ton of money on upgrades. It's an absolute onslaught, and nobody is immune. So when you're faced with this kind of perfect storm, what do? Well, the response has been pretty radical. We're not talking about small budget cuts or finding little efficiencies. These companies have decided the best way forward is to get smaller, leaner, and way more focused. They are literally performing corporate surgery on themselves, carving off huge parts of their own businesses. And you can see this strategy playing out across the board. It's not just one company. Baxter spun off its entire massive kidney care division into a brand new company called Vantif. BD is in the process of spinning off its biosciences and diagnostics units and merging them with another company. And ICU Medical just sold a 60% controlling stake in its IV solutions business. Everybody is shedding big assets to become more nimble. But why? What's the goal for each of them? Well, for Baxter, the motivation is crystal clear: deleverage and simplify. That huge Hillrom acquisition they made left them with a mountain of debt. Spinning off the kidney business gave them a big pile of cash, and they're using almost all of it to pay down that debt. The end goal is to be a leaner, more focused company with better profit margins. BD's move, though, is a little different. It's more of an offensive play. They're already the top dog, but they're getting rid of some of their businesses that go through big up and down cycles. Why? So they can double down on what they do best: selling tons of high-profit consumables, things like catheters and syringes that hospitals use every single day. They're also using that freed-up focus to push into the future, buying up an AI-driven patient monitoring business. This is about them going from just a great company to an untouchable, blue-chip powerhouse. An ICU Medical strategy might be the purest of them all. By selling off most of their manufacturing, they're going all in on that classic razor and blade model. Sell the razor cheap to lock someone in, then make all your money selling them the high-margin blades. They want to be a company that doesn't own a ton of factories, focusing all their energy on one thing: selling the profitable disposable blades for the razors, their infusion pumps, that are already in hospitals. It's a pure play for higher profits and less risk. Okay, so we've decoded the numbers, we got the strategy. Now for the most important part, the investor's playbook. What does all this maneuvering actually mean for the future of these companies? How should you and I think about them? If you really want to understand why Baxter felt so much pressure to do something big, just look at this chart. For the last 5 years, their stock, that's the blue line, has gotten absolutely crushed. It's way behind the overall market and even the healthcare sector. This chart isn't just data. It's a picture of immense pressure from Wall Street. Making a big move like the spinoff wasn't just a good idea for them, it was an absolute necessity to try and get investors back on their side. They always say follow the money if you want to know what someone's real priorities are. Well, this table does exactly that. For Baxter, priority number 1 is debt. They used about $3.3 billion from the spinoff to pay it down. Done. BD, on the other hand, is flush with cash and feeling good, so they're focused on growth and rewarding shareholders. They're spending billions on acquisitions and giving money back through dividends and buybacks. And ICU Medical? They're kind of in the middle, using the cash from their sale to shore up their own balance sheet and pay down debt from a past deal. And this quote from the HDIN Research report that all this is based on, it just nails it. 2025 is the global medical device giants' first year of transformation. They are breaking apart to build something stronger. So this isn't about a crisis, it's a deliberate transformation. They believe they have to break themselves apart to build something that's more resilient and more profitable for the future. So let's boil it all down. Here is the final playbook. For BD, the investment thesis is that they are becoming the ultimate blue-chip platform, super stable, super profitable, and always growing. The big risk to watch? They have to smoothly integrate that new patient monitoring business they bought. For Baxter, it's a classic turnaround play. The big question is, can management successfully pay down the debt while also fixing the ongoing issues with their infusion pumps? And for ICU Medical, the bet is that they become a super profitable niche leader. The risk for them is all about regulation. They have to resolve an FDA warning letter from 2025. That's a must-do. Now, we have covered a ton of ground here, but honestly, we've only scratched the surface. All of this data, all of this analysis comes from a really detailed 18-page report by HDIN Research. If you want to get into the real nitty-gritty, you can download the whole thing for free from their website. So we started with that big question: is this a crisis or an opportunity? And I think the evidence is pretty clear. This is a massive, calculated opportunity. These companies aren't running scared from all the challenges. They are fundamentally reshaping themselves to take them on. And that really leaves us with one final fascinating question to think about. Now that these giants have all chosen their unique paths, the blue chip, the turnaround, and the niche leader, Which one of them is best positioned to not just get through this tough time, but to truly dominate the next decade of healthcare?